This video will cover preparation of North Carolina tax returns for full-year residents. As you view it, you can and you should pause the video at any time to go back to a prior section if it's not clear, or to answer questions and work problems that I'm going to present to you later on in the presentation. There's going to be a lecture section initially covering tax law and some things about tax layer input. Then there'll be a quiz, and then a sample problem using the 2020 Tax Layer Practice Lab and the NTTC workbook that you've worked with last year. There haven't been any changes to North Carolina tax law for 2021 as of today. So learning to handle the 2020 tax return for North Carolina should fully prepare you for 2021. So let's get started here. North Carolina is considered a flat tax state, which means it has a relatively simple tax return. All the income is taxed at the same rate, which is 5.25%, and there are very few state tax deductions that exist, and only one credit that is within scope. We're going to, of course, only cover what's in scope for AARP, for resident returns, and then there's two other presentations you may want to view. One will be for non-residents who are paying tax in North Carolina, and for part-year residents. For full-year residents, all of the income that they earn is taxed regardless of where they earn it. And for part-year residents, that's the same for the dates that they are residents of North Carolina. Non-residents of North Carolina only pay tax on the income that they earn within the state, which could be wages, self-employment income, real estate income, or gains on a sale of real estate, or gambling income. And taxpayers may get a credit. Resident taxpayers may get a credit for taxes that they pay to another state, or in the case of North Carolina, they may get a credit for taxes they pay to a foreign country. Similar to the federal rules, only certain taxpayers are required to file. Full and part-year residents are only required to file if their federal adjusted gross income is greater than the North Carolina standard deduction for their filing status. Then they have to file a return. And for non-residents, their AGI, their federal AGI, must be greater than the North Carolina standard deduction, and that's their entire AGI, not just what they earned in North Carolina. And of course, they must have North Carolina sourced income, otherwise they wouldn't be filing. These are the dollar levels for the standard deduction in North Carolina, and they range from $10,750 for single and married separately, filing separately, all the way up to $21,500 for married filing jointly and qualified widow and widower. There is a potential complication here, and that is that the threshold for federal filing is higher than that for North Carolina filing, because, for example, the standard deduction for married filing jointly for federal is $25,100, whereas it's only $21,500 for North Carolina. So there's a few taxpayers that might earn enough in North Carolina to file, but don't have to file for federal. If you run across someone like that, we would prepare both the federal and the state return, and we'd probably file the federal return anyway, because more and more we're seeing situations where people are going to want to have their tax returns on file with the IRS. There have been stimulus payments and advance credits and refundable credits and things that they want to have their information on file. As with all of the state tax prep, you begin by completing the federal return in tax layer, and most of the input for North Carolina is actually done in the federal section, just as it is for other states. Things such as identifying dependents, identifying tax-exempt bond interest and dividends that are not earned in North Carolina, federal interest that will be deductible. Social Security is not taxable in North Carolina, but it was originally entered in the federal, of course. And then if there is taxable Social Security, it will be deducted. Any itemized deductions are done in the federal section and then carry forward. And then taxes paid to another state or foreign country may be entered directly into the federal return. North Carolina begins with federal adjusted gross income, not with taxable income as some other states do. But some of the federal adjustments and deductions that apply to AGI are not applied when you arrive at North Carolina taxable income. But thankfully, most of the things that are not conforming as adjustments or deductions are added back automatically in tax layer because the rules are pretty well known. So North Carolina adds the following items to federal AGI to arrive at its taxable income. Any exempt interest and dividends that are earned outside of North Carolina have to be coded into the federal section, just like other states. The above the line charitable contribution amounts, as you know, these are charitable contributions that can still be claimed even though the taxpayer is not itemizing. For 2021, that can be up to $300 for single filers and $600 for married filers. But North Carolina did not adopt this deduction, so those amounts are added back to federal AGI on the North Carolina return. Also added back in 2020, probably won't repeat in 21, the unemployment compensation income exclusion of up to $10,200 that was applied for federal for unemployment payments. North Carolina did not adopt that deduction. So those amounts are automatically added back as income in North Carolina by tax layer. North Carolina also doesn't accept an adjustment for the discharge of qualified principal residence debt or the tuition and fees deduction. So those are two things you could deduct for federal. The tuition and fees deduction expired at the end of 2020. But in any case, those two, if you run across those as deductions for federal, they have to be manually added back in the North Carolina return under additions to income. And there are specific boxes for that, which I'll show you later. North Carolina does allow a few subtractions from income. Most of those are also done automatically. State refunds, if a state refund is taxable for federal, it gets eliminated for state. The state isn't going to tax its own refund. Interest on US obligations, so this is treasuries, CDs, and other obligations that are directly federal government, coded in the federal section as deductible for North Carolina. Again, Social Security is not taxed, so that gets taken off if there's any taxable amount on the federal. The 1/2 of self-employment tax also, because we're starting with federal AGI, that is also essentially a deduction in North Carolina. And then there's a child deduction of up to $2,500 per child. And the child is defined the same way as federal child tax credit. So a child age 17 and less at the end of the year, who's a dependent and who has a Social Security number. This is not a credit, it's a deduction of up to $2,500. And the $2,500 phases out with income at higher levels. There's also a few deductions that have to be manually entered under subtractions from income. One is called the Bailey settlement pension distribution. Most pensions are taxable in North Carolina, except for those that qualify for the Bailey settlement, and I'll explain that on the next slide. Also, any deposits in a personal education savings account up to $9,000 is deductible for state. These are pretty rare. They relate to special needs students and special savings accounts for their education. I'm not going to go into the details, but I'm going to provide you with a resource if you want to get more information. It's not that likely you'll see that, but you should just be aware there is another subtraction there. So let's talk about the Bailey deduction. Certain pension distributions, including a survivor earning pension benefits, if the pension was earned while employed by the federal government or state or local governments, they will be deductible for residents. All the other 1099-R retirement income is taxable in North Carolina. There's no specific deductions for retirement income. And the way the Bailey works is the pension income has to be paid from a particular qualified employer. And that includes the military, the federal government, state and local governments, teachers and safety officers. But there is a specific list that exists to look up these employers to see that they are included as Bailey eligible. And there's a slide, a resources slide later on where I'll provide you with a website for that. In addition, the taxpayer has to have had at least 5 years of service before August 1989, because that was the ending date of the Bailey lawsuit settlement. Or if this distribution is from a 401k or a 457 plan, then they must have contributed to that plan before that date. Now, if they took money from, say, a 401k and they rolled it into an IRA, and now they're taking withdrawals from the IRA, they've lost the Bailey exemption. There's no, you can't look back and say this IRA withdrawal was originally from a 401k that was Bailey eligible. They just lose that. But typically speaking, most of the Bailey deductions are from classic defined benefit pension plans. Now, if it's a state or a local employer providing the 1099-R, most of them do note that this taxpayer is eligible for a Bailey deduction. But if they don't all do that, and also federal employers like the military or the civil service, they're not focused on North Carolina, so they do not indicate that on the form. So you just have to know and have available to you the resources to determine whether there's a Bailey deduction available to the taxpayer. After you apply all those additions and subtractions, the next thing to handle is whether they're eligible for the standard deduction or itemized deduction. As we mentioned earlier, the standard deductions are lower for North Carolina than they are for federal. In addition, there's no adjustment for age, blindness. So particularly since a lot of our clients are senior citizens, where the standard deduction next year will be $27,400, that's quite a bit of difference between the $21,500. So again, you may find people who have enough to itemize for North Carolina, even if the federal standard is higher. Now, because of these differences, as I say, it may be advantageous for some people to itemize for state, even though they're taking the standard for federal. So what we would do, of course, we could examine the deductions, and if it's clear that they only have $5,000 of deductions, then they're clearly not going to want to do itemized deductions. But if it's close or we're not totally sure, we would enter all the qualifying itemized deductions in the federal section, and then TaxSlayer will apply the rules in North Carolina to determine whether the itemized deductions are higher or not for federal and state, actually. So if we're not sure, let's go ahead and enter them and allow the software to help us out. A couple of rules around the itemized deductions for North Carolina. As with federal, the medical expenses are limited to just the excess over 7.5% of the federal AGI. State income taxes and personal property taxes, like on a car or a boat, those are not deductible in the state. And also the real property tax payments are limited to $10,000, which is not typically a That's pretty high level for most of our clients, but there is a limitation there. In addition, the sum of the property taxes and the home mortgage interest, if there is any, the total is limited to $20,000. So again, that's a fairly high income person, but you might run across someone who had a high mortgage and some property taxes, and that would be limited by the software to 20,000. And another interesting feature is that gambling losses are not deductible, even if they are itemizing, and if they have gambling winnings, they cannot deduct the losses for North Carolina. Okay, so all of that gets entered either in the federal module or a few adjustments are made in the state module. And then the system will take taxable income, multiply by 5.25%. And then there's really only one tax credit that's available to people that's in scope, and it's non-refundable. And it's a credit for taxes that are paid to another state or to another foreign country. North Carolina does include potential for a foreign tax credit. Typically, the credit for taxes paid to another state is calculated automatically. So for example, somebody lives in North Carolina, works in South Carolina, pays taxes in South Carolina through their job. And once you start a non-resident South Carolina return, then TaxSlayer will know that on their resident North Carolina return, they may be eligible for a credit. But you have to check these amounts because it's not always the case that TaxSlayer picks it up automatically. So you'll need to check that. In fact, there is a calculation going on for taxes in both states and a potential for a credit for taxes paid in the non-resident state. In terms of the foreign government taxes, that generally has to be done by hand. Now, what typically you see is on a 1099 INT or DIV or a broker statement, you will see foreign tax paid. And as you know, there's a credit for that for federal. Well, there's also a potential credit in state, but you have to go into the credit section of TaxSlayer's North Carolina module, and you have to enter the amount of foreign tax that was paid, which country it was paid to, if you know. If not, you can put other countries, and then what income is attributable to that country. So we select a country if it's shown on the statement. If not, we'll select other countries. We enter the tax that is paid and the income from that foreign source. Now, when you have a broker statement, you may at the back of the statement or somewhere within the statement, it may show what country the income was earned in that's taxes being paid on. Maybe on the page, the supplemental pages, where they also show where the tax exempt interest comes from or things like that. If it's not clear what state or what country the income came from, then and how much of it is, we can take the amount that was paid in foreign tax, divide by 0.15, and use that as the implied foreign income. What you're doing there is you're implying that this other country had a 15% tax rate, because we know what the tax rate is. We know what the tax amount is. We're implying that the rate was 15%, so we can therefore back into what we think the foreign income is, and that's an acceptable way of analyzing this and entering it. And finally, as in other states, North Carolina wants to be paid sales tax on any purchases that were made out of state where they didn't pay tax. But with Amazon and other online providers beginning to collect more sales tax, regardless of where you live, it's less likely that they made major purchases outside of the state and didn't pay income tax. So there's a few options you have to handle this. If the taxpayer tells you that they did pay sales tax on any out-of-state or online purchases, then you don't need to enter any consumer tax. You can take it's their return, and you can take their declaration. If they provide you evidence of the non-tax purchases, then you can calculate the sales tax based on the location of where they live, and there are tables to look that up. And finally, you can do an estimated sales tax based on their income using some tables provided by North Carolina Department of Revenue in the instructions to D400, and D400 is the 1040 of North Carolina tax returns. It's the main return. So you can do that. In most cases, taxpayers will tell us that they didn't buy anything that they didn't pay sales tax for, and it's their return. We accept that, and we take option 1 here. Okay, I'd like you to pause the video at this point. Here is a list of 10 questions for you to answer to yourself. See if you remember what I just went through. You can pause the video, go through and try to answer these before I take you through the answers. If you'd like, you can also return back, rewind, if you will, back to the previous parts of the presentation to see if you can find the answers. So I'm going to pause here for a minute, and then I'm going to start up again. So pause the video for you to make the answers. Okay, so first question, true or false? North Carolina has a complicated set of tax rates and credits. The answer is false. There's really only one tax rate. There's only a few deductions, and there's only one potential tax credit. So it's a fairly simple return to complete. True or false, if a taxpayer takes a standard deduction on federal, I still have to consider itemized deductions for North Carolina. And that is true. The standard deduction is lower in North Carolina, so itemized deductions may still be higher, even if they weren't on federal, and there's some differences in the rules, so you still have to consider them. True or false, I enter any itemized deductions for North Carolina in the state section. And that's false. Those are entered in the federal section the same way you would for federal itemized deductions. Number 4, true or false, only residents may need to file tax returns in North Carolina. And that's false. Anybody who had North Carolina source income may need to file. Again, though, it depends on where their income is relative to the standard deduction amounts in the state. Number 5, what federal amount does the North Carolina tax calculation begin with? And the answer is adjusted gross income. Name 2 ways that dependents figure into the North Carolina tax return. Well, they figure into the standard deduction because they may determine someone's filing status. They may not, but obviously head of household or qualifying widow or widower, that will affect the standard deduction that the taxpayer is eligible for. And they may determine whether there's a child deduction available. That's that $2,500 up to $2,500 amount that they may get for qualifying children. How do you reflect tax exempt interest on the North Carolina return? You want to use the add interest or dividend items buttons in the federal section, screens, the INT and DIV screens to reflect any amounts that are taxable in North Carolina. And true or false, all pensions are taxed in North Carolina. Not completely. The one exception is any pension that qualifies for the Bailey settlement, which figures to the next question: how do I find out whether the taxpayer has a Bailey pension? So you want to compare the payer on the 1099-R form to the list of qualifying employers that is available online, and then determine whether the taxpayer had at least 5 years of service by August of 1989, or if this was a 401k or 457 withdrawal, whether they had contributed to the plan by then. If those conditions are all met, then you have a Bailey pension, and that is deductible for North Carolina tax. And then finally, true or false, the only tax credit in scope for North Carolina is a credit for taxes paid to another state or country. And the answer is true. Okay, hope you got most of those right. If you didn't, you can again go back and try to figure out how you missed that. And this is a listing of some resources for you as you prepare North Carolina tax returns. There's a volunteer guide actually put together by North Carolina Volunteers Guide to Preparing the Return. It mentions VITA there. This particular website is the 2020 return, and there's no real difference between VITA and AARP tax aid because everything in scope and out of scope for VITA for North Carolina is also the same as AARP. So you can certainly look this through, gives you some more explanations of what goes where. There's a website here on the Bailey settlement pensions. It lists all of the payers that qualify. You can also Google Bailey settlement pensions and you'll come up with a dozen articles as to how it came about and how it works. And then finally, I'd mentioned those personal education savings accounts that where someone could put in tax deductible deposits. And this explains that. But once again, I wouldn't expect that you'll run across it. Okay, now we're going to take a quick tour of Tax Slayer's input screens and outputs before going on to doing a practice problem. So this is a practice problem that I put together just for examples purposes. The man's name is NC Practice and his wife's name is Ellen Jones. So there you go. I'm going to go through the printout of this a little bit and then I'll show you some of the entry screens. So this person happens to have a job. Here's their W-2. They've got North Carolina wages and income tax withheld. And another thing to point out is they have a Bailey pension. They worked for North Carolina teachers. And while it doesn't tell you what dates they work there, you can take it from me that they worked there for at least 5 years before 1989. So that this is a qualifying Bailey pension. As I was saying, it may show down here on the real form that it's Bailey, but it may not. So they'll just have to examine it carefully. Here is their 1040. They had, as I said, a job. They had some tax exempt interest of $166, which I programmed in as not being from North Carolina. They had some taxable interest. They had some dividends. Here's their Bailey pension. Some of their Social Security was taxed. A lot of it was taxed because of their income level. They had some capital gains. This 2367 here is gambling. You'll notice that they had an above the line charitable contribution of $300, which last year in 2020 was the most that they could have. Again, this year it's going up to $600 for couples. They had a standard deduction because they were seniors of $27,400. They had some tax. They had a $37 foreign tax credit. So in general, they owed $13,000 and they actually owed money for federal for what it's worth. Okay. Here's their gambling income on Schedule 1. Here's their foreign tax credit on Schedule 3 of $37. That's the foreign tax that they were paid. We went ahead and populated their itemized deductions, but you will see that they only ended up with $23,154, so that's less than the standard deduction. So they took the standard deduction. Okay, so now I'm going to just come down all the way to the North Carolina tax return, and here it is. The return is called the D400. The first page of the D400 is really a computer input page, so it's really not readable. The information's all there, but not readable to us. Second page is that's pretty much that same information, a little more readable. North Carolina doesn't make an attempt to come up with a very pretty form, but it works. As I mentioned earlier, they begin with federal adjusted gross income, which was $129,265. Then they had an addition to that income of $466. That was the $166 of tax exempt interest from another state and the $300 above the line charitable deduction that they don't give you any credit for. Okay, so that gets added in. And then they had some deductions. This $58,000 was the taxable Social Security and the Bailey pension, those two items. Then if they had had a child and the child had qualified, there might have been an amount here for child deduction. Then we look at their standard versus itemized. So on line 11 here, standard deduction, yes. Itemized deduction, no. And so this 21,500, even though it was less than the amount that they could have declared on federal, is obviously more than what they could have declared on state. And that might have been because some of their federal deduction was state income taxes, and that can't be deducted for the state. So they're left with deducting the standard deduction. And so therefore their taxable income is $50,141. They then take 5.25% on that, which is $2,632. Then on line 16, you'll note that they did get a tax credit of $9. It wasn't $37 like they got on federal. It was a smaller amount, and that'll be shown further down. So they owe $2,623. They had withholding, and they actually paid some estimated tax. So their payments were $1,904, and therefore they owe $719. You know, again, this form is not all that pretty with the formatting, but it is what it is. You further down, you'll see some supplemental schedules. Here's the supplemental schedule on the additions to federal gross income. So there's the $166 interest income from other states and the $300 above the line qualified charitable contribution. So that much is being added back. And then here are those deductions for the taxable Social Security and the Bailey settlement. So that's a schedule that goes behind the D400. And then finally, this is showing you the credit for taxes paid to another country. So they had $71,600 of income. Only 227 of that was from another country. So only 0.0032 of that was from a foreign country. Therefore, even though they had a good amount of foreign tax paid, they only get credit for $9. Okay. And then this shows you the two countries that they had foreign tax from. Kind of unusual. Usually you won't even know the country. You'll just have to say other countries. Okay, so that is the print results screen. And then here we are with the entry screens. I'm going to go into the federal section just to point out that, as you know, under interest and dividends, there are sections in here, and I don't recall which one it was, where you can enter the tax exempt interest. Here's your foreign tax withheld, of course. I guess it's in the dividend one. Okay, so here's your dividend entry. And we had $166 of exempt interest, but a common mistake people make, they forget to do the edit of the items. And in this case, for North Carolina, we're adding back 166 because it was interest that was earned outside of North Carolina. So when we go to do the North Carolina return, we're going to have to add it back. The retirement income, nothing special there. You don't indicate a Bailey in the federal part here. Here's your itemized deductions. I did put them all in here, but since they didn't itemize anyway, I don't really want to necessarily go through them. You know how to do itemized deductions. One of the interesting things is that even though this is the federal section, if they made a state estimated payment, you have to put it in this federal section under payments and estimates. So you have to go into payments and estimates. Here they applied 175 from last year. It wasn't really an estimated payment, they just applied it. So you have to put it in there and you have to indicate what state. That's really pretty much the only thing on the state related payments that end up in the federal is this estimated payments or applications for prior years. Okay. Then we're going to the state portion. We had a resident return, of course. And as we go into the resident return, it'll look like every other state return. There's going to be a basic section that you have to go into, and you have to indicate what county they live in. And most of the rest of this is not required, but survey questions about whether they're a veteran or not, whether they had a PIN, unlikely, whether they were in or out of the country, etc. So you may want to look at that, but primarily it's the county. If they had had any additions that weren't already reflected elsewhere, then you would have had to put them in here. But for example, tax exempt income from another state that's not included in your federal income, but we did include it. So we don't have to worry about that. Further down here, as I mentioned, the discharge of qualified principal residence indebtedness. So if they had some principal resident indebtedness discharged and they got to deduct, they didn't include that on their federal, you would have to add it in here as taxable for the state. And similarly with the qualified tuition, you would have to add it in here. So that is what's called additions to income, manual additions to income, if you will, and then subtractions from income, the primary thing being the Bailey settlement. So that's put in as a subtraction. As other states have retirement income subtractions, this is pretty much where you put in the one from North Carolina, and they remind you that there's a total taxable income from pensions of $28,422, but this is the only amount that was Bailey eligible. Okay, and then as we said, there are credits. You don't really need to do anything in itemized because you're not going to find anything that's just specifically North Carolina. And then in the credits, you may have a credit for tax paid to another state or country. So in here, I had two countries. I had Belgium and other countries. Most of the time, you're just going to have other countries. You can add a state or add a country. And when you do that, if it's a state, you're going to select the state here. If it's a country, you're going to select the country here, or it's just going to be other countries. You need to know the income from that other state, or country rather. But as I say, if you know how much was paid to that other country, you can divide that by 0.15 and enter that as the income. In the absence of having the income reported. Of course, if it's reported on the broker statement, then that's what you're going to use. Okay, and you can add as many of those as you want. Again, if it's someone who's commuting to another state, probably you won't have to enter this because it'll already come in automatically. But if it doesn't or needs to be adjusted in some way, this is where you're going to go. And as with other states, you never want to exit out in the middle of a tax return. You have to either do a back or a continue until you get to the place where you can actually exit the return, and then that's where you're going to exit. Otherwise, you'll lose your data, or you may just get a warning that you're going to lose your data. But that's what's going to happen. Okay. So now we're going to have you do a sample problem. I'll give you the problem, I'll give you the answers, and then you can pause and do the problem. We're going to start with the Parsons problem that you did last year for certification. It's page 137 of the workbook. You don't have to re-enter any of this information. You can just use the problem that you already did last year. Unless you really want to keep a copy of it, then you'd have to re-enter the whole problem. Otherwise, just begin with that problem, including the 20,000 of Canadian lottery winnings that were given as a supplement last year. And then I want you, if you're going to just use the same entry, just delete any South Carolina tax return that you prepared, because we're not going that direction. We're doing North Carolina. Some additional information for you to consider. One is that they received 2 stimulus payments, $2,400 and $1,800. The reason I have this is that the work we did last year didn't have the second stimulus payment in it. It was too early for that, so I want to make sure you have them both in there. They're full year North Carolina residents, and their tax exempt dividends on the broker statement on page 142. The tax exempt dividends came from South Carolina, and the tax exempt interest that's shown on that form came from North Carolina 40%, Puerto Rico 10%, and Florida 50%. Also, the Parsons forgot to bring their mortgage statement with them. And so you don't see it in the problem there, but they show it to you on their phone. And it turns out they paid $13,000 in mortgage interest to the NC Bank. So you may need to consider that. And then finally, Ben, who has a 1099-R there, he belonged to the Federal Civil Service Retirement System when he was working at the US Postal Service. So you should be aware of that. Okay, again, you can come back to this page if you need to get this. Here's your check figures for Parsons. Your federal AGI and your refund should be what you already have in TaxSlayer if you did the problem correctly last year. But since you didn't do anything with North Carolina, I'm going to tell you that your North Carolina refund, when you finish, should be $179. Okay, so what you should do is pause this video or stop it and come back to it, whichever way, and then work the problem, and then continue the video as I discuss the answer. Okay, I hope you found that to be pretty straightforward. I'm going to tell you what you should have found, and then we'll go look at the TaxSlayer forms for that to see how I put it all in. So you should have found the following inputs. You should have added back $345 for the tax exempt dividends that were earned in South Carolina, and $62 in tax exempt interest from non-North Carolina sources. Now remember I said North Carolina was 40%, Puerto Rico was 10%. Puerto Rico is not taxable in any state. So really there was 50% that was not in North Carolina that would be added in as taxable in North Carolina. Ben's pension did qualify for a Bailey deduction because it came from a qualified payer. And you could have looked that up, or you could take my word for it that federal civil service people are part of the Bailey. And he had 5 years of service by August 1989. And how do we know that? Because he began his employment in January 1980. I told you that. If you go and do the itemized deductions, including the extra mortgage interest, you will find that they actually can benefit from itemizing North Carolina, even though they still are better off with the standard deduction in federal. And we'll show you that. And they do receive a $1,000 child deduction for Madison based on the filing status, but also their income is too high to get the $2,500, so it gets phased down to $1,000. And you'll see that they get $1 of tax credit for taxes paid to another country. We don't know what country it is, wasn't in the problem, so we'll choose other countries. And since there's no foreign income amount given, we'll take the $12 that they paid in foreign taxes, we'll divide it by 0.15, and we'll enter that $80 of foreign income. And it's a very small tax credit because they have a very little amount of income that relates to a foreign government as opposed to all of their domestic income. so they don't get much credit. Okay, so let's take a look at the paper returns from Parsons and Harper. So here they are. They're 1040, which you should have already had. They're married with a child. They have tax exempt interest. They've got taxable income. They've got some pensions, and they've got some Social Security. They actually have a capital loss, and they have some other income. I'm going to go to the itemized deduction, and you'll see that they have 23,256 in itemized deductions, of which very little is state income tax. So what will happen is they will have more itemized deductions for North Carolina than the standard deduction, but not enough to qualify for the federal itemized deduction. That's why I put the problem together that way. You'll see we added mortgage interest of $13,000 right here. Okay, so it's designed to show you that there can be differences there. Now I'm going to just quickly spin down here to the D400. And here it is. Okay, again, we began with the 80308, which was the federal AGI. This time we added 707 of additions, and that was the non-North Carolina tax exempt interest of 407 and the $300 above the line charitable deduction that they don't get credit for. We had some deductions. That was the taxable Social Security and the Bailey. This time in this problem, we have a child deduction. We have one child and we get $1,000 from that as a result of the income. This time standard deduction, no. Itemized deduction, yes. And it figures out their itemized deduction is 22,547, which is greater than the standard. They come down with 10,545 of taxable income multiplied by 5 1/4. You end up with $554 of tax, and they get $1 off for the foreign tax credit, so they owe $553. By the way, I don't think I mentioned, but this line 13, part year resident and non-resident taxable percentage, that's going to become important in future presentations as we talk about those situations and what portion of the person's U.S. income is taxable in North Carolina. But in this case, it doesn't apply because all of it is taxable. Okay, so they owed $553, they had $732 taken out, and as a result, they overpaid $179. Down here, as we've shown you before, here's your 407 of interest income, your $300 of above the line charitable. So that's the schedule behind the 707. Here is the schedule behind the deductions for North Carolina, the taxable portion of Social Security and the Bailey settlement. And then here is an analysis of their itemized deductions. So they got the home mortgage interest deduction. They had some real estate property taxes. That was the total. That is limited to 20,000, but it's under that, so they get to keep it all. They had 6,500 in charitable. They had 8,145 of medical, which is reduced by 7.5% of AGI, federal AGI. So they only get 2,122 of that. So the 1,395, the 6,500, and the 2,122 add up to 22,547, which is their itemized deduction. And then finally down here, they had total income of 34,092. Only 80 was from another country. So it's a very small percentage is from another country. So even though they did have foreign tax paid of 12, they end up with only $1 of credit against North Carolina. Okay, so on the inputs, of course, there were some parts of the federal where they had to put in the interest and et cetera. Won't go through all that again. But let's take a look at the state section here. Again, they were a North Carolina resident. They had to put in their county. Under the basic information, they put in Mecklenburg. Under the subtractions here, you had to put in the Bailey settlement amount, 25,122. We didn't have anything else there. We didn't have any additions because they didn't have the tuition and fees and things like that. And then you had to go into the credits section, and the credits for taxes paid to another country. In this case, OC, meaning other countries. They paid $12. We implied $80 income. And so that's how we filled that out. That is it. The only other thing, which I didn't mention earlier, is if you do have a situation where you want someone to get estimated tax forms or something like that, that would be in the miscellaneous forms area. Okay, so that is the persons problem. Hopefully you were able to pull all that together or go back and do it on your own. Any questions, any comments you have, feel free to talk to your training coordinator or instructors. And you can email me at this email address. Thanks very much for your time, and good luck this season.